managerial accounting, absorption costing versus variable costing. Now, what we're looking at here is a comparative income statement for our single product company under scenarios A and scenario B. Now, recall in our data section that the product sells for $200 a piece, and in terms of units, in situation A, we produced 9,000 units and sold 9,000 units. And in situation B, we produced 10,000 units but sold only 9,000 units. So let's notice a couple of things about this comparative income statement for scenarios A and B. First of all, since the same number of units were sold, 9,000 in both situation A and situation B, the total amount of sales revenue is the same, $1,800,000. And obviously these numbers are in thousands of dollars here. So the same number of units were sold at the same price of $200 per unit, so our sales revenue is $1,800,000 for both scenario A and scenario B. Notice also that the selling and administrative expense amount is the same in both scenario A and scenario B. Under both absorption and variable costing, selling and administrative expenses are period expenses. They are expensed as incurred. So the selling and administrative expenses, this is made up of the variable portion, which was $20 per unit, times the 9,000 units sold, or 180,000, plus the fixed portion of $480,000. And you may want to refer to the data video to refresh your memory on those amounts. Now, since 9,000 units were sold in both periods, the variable portion of the selling and administrative expense is the same, $180,000, and the total fixed cost is the same because our assumption is that we're in the relevant range for our cost behavior definitions. So the selling and administrative expenses are the same in both scenario A and in scenario B, $660,000. Now, what's different between scenario A and scenario B? Well, the difference is in cost of goods sold, which in turn impacts gross margin and net operating income. Cost of goods sold in scenario A is $900,000, but in scenario B is $855,000. Now, how can that be? We sold the same number of units, 9,000 units, in both scenario A and scenario B. Everything else is assumed to be the same, except the number of units produced. So how is it that cost of goods sold differs between these two scenarios? And in turn, that cost of goods sold difference impacted the bottom line net income. Net income, $240,000 under scenario A, and under scenario B, $285,000. So how is it that cost of goods sold for 9,000 units in scenario A is different from cost of goods sold for 9,000 units in scenario B if all the costs are the same? And in turn, how does that lead to a difference in net income? So this is what we're going to be examining in the next video. To figure out where this difference came from, the first thing we need to do is determine how we calculate product cost per unit under absorption costing. And that's what we'll be doing in the next video.